Okay, this is trend part two. Welcome back, welcome back. In the first video, we learned about just the simple trends, so higher lows, higher highs, highs, lows, everything. So quickly right here, a quick recap. We said a high is a point where the market, let me use this one, a point where the market goes up, and then from the point up, it goes down, that makes your low. And then the next push up, so the highest point, let's say around this area in here, is your high. Then you have the push down as your low. Then you have this is a high. Then this is a low. This is a high. And then in here, plus or minus, this is a low. This is your high because we had the push up, then the wick down. So this is like a mini low. And then our next high would be probably up here. So again, your chart looks very, very messy, but you need to know where are the highs and where are the lows. In this part, we're gonna learn about how to spot major highs and lows and which ones to look at. So, in the first lesson, we learned about just every single high and low. Now we need to learn about how to spot a key level high and low. So in this situation here, we have got the 15-minute time frame. We are trading based off liquidity, which you will learn later. And basically, we want to buy and sell after a low or a high in the same trend. And for that, you need to know how to spot a key level high and low. So in this situation, we've got our last here, we've got the last high, right? This is our last high. And what we learned about is this would be the low. So after the move up, we have the push down. Now, again, push up, push down. We learned that wicks means price went up and went down. So this is the high, and then this would be the low. But we are not looking in here to trade because it's not good, you could say. It's not key levels. We can catch better trades and get a better understanding of the market by doing like this. Again, we mark out the next high and low would be this would be the last high, and then this would be again a high right here. So the price didn't break above, so this would be your high here. Well, you could mark out the wick. So here, the wick. This is your high. Now, as we can see here, we've got the first high, second high, third high. But also inside here, you've got this high, as you can see. But that would make this your low if you use that high, right? So if we remove and we use this high in here, that would have to be this low. But as we can see, the price did not respect this low here and it went lower. Why? Because this is not a major high. This high, it's not a major high and low pairing. It is a major high because it never broke above, but it's not a major low. And how do you spot that? Again, we draw out our high, right? And instead of using the next random high created inside of this range, so the range would be from here to here. This is your range in here. So if you draw a box around the range, this is your range. You don't want to use a high or a low inside the range, okay? You wait for the range to get broken. And where does the range get broken? The range gets broken with this big up candle and making this high, right? So that's your next high. So in reality, your next range is from the bottom here up to here. That's your range. That's your new push up range, okay? Sorry, wait, let me just, yeah. So that's your range again. You don't want to buy or sell anything in this range. So then we wait for the range to get broken. The next range is this push up. So that's where we drew this wick here, right? But now, this is where the confusion comes. If this is your high, you don't know if you should mark this or you mark out this. what you look for is when the price breaks out of your range like this. So this is what we call a break of structure, which you will learn later. When it breaks out of your range, you mark out the lowest point before the break. That would be this as your low right here. After this range, this low, and then this is not your low because we didn't break the range here. We broke the range only after. So that would make this is your key low, making your range. So let's get the drawing out. So wait, let me just, this is your range here. And then where did the next range get broken? After this high, what we have marked out here, this range up here. So after this range gets broken out, this is your new range from, sorry, well, yeah, your range, how would I explain this a bit better just to not confuse? Yeah, okay, so this is your basically your range of your push up, right? And this is your next range. So this is the break of your push high here. From here, these up candles. So a high is made by up candles. So we have our up candles here to make a high, up candles here. So then you mark out the lowest point before you get this blue line up this range, and the lowest point is this as our low. So this becomes our low, and then your range looks a little bit, or not your range, your trend looks more like this. So we marked out this, then you have your low, and then you have your high, right? So it's not like this. It's not up here, then this small low here, then up here. Or sorry, it's not. Then look how messy this looks. It's not from here to here to here to here to here to here. It's a bit more messier. There's more stuff in there. It's more simple, just up, down to this last low, because this is where we broke out of this range, and then up. So using the same logic, okay, using the same logic, we will draw out the range. So we've got our low up to the high, wrong tool. We've got the low up to the high, then we've got our low, and we push up. So now from here we have our break, we have our break. Now this high, we break it? We break it with a wick, but we use bodies only to make sure that it's a break. Here you have body and there you have body, making this a valid high and a low. If you have no break, it means your high would be here, the highest point before we get a proper push down, because the price went down to here, but we never. This is a low, okay? This is a low. But when you see the price moving up, you might say, okay, we might create a major low here. But when you see it wicks and it doesn't create, this is not a valid low. So then you have that as your high, and now you wait for your low to be formed, which is here, before you get your big break from this high in here. That's how you spot major levels. So now, why do we spot major levels? Because when this low gets broken through, the price doesn't buy straight away. What does it go and look closer? What does it break? It goes and it breaks our major low first. And within a candle of breaking the major low, we get the push up. You will learn why this happens, what this is called, and how to look at this and trade. So then you would be entering off of, instead of this low getting broken here and you get stopped out like this in your trade, so this would be a loss. You are entering down here after your major low gets taken, broken, gone under, and now you will be getting your trade. So that's how you spot major lows. Quick recap of major lows and major highs when we draw out paint. Your major highs and lows, a major high and a low must have a break. When you have a break, then you have the highest point after that break, and you have the lowest point before the break. That's how you spot it. So when you have the market moving like this, from here, where is the major, low, and high? So we've got the highest point. After the highest point got broken, we find the lowest point before the high got broken, and then we have the highest point. So there you go. Major high, major low, major high. That's how you spot major highs, lows. Sometimes the little lows in here come, these little lows and these little highs do come into play, but that you learn later, what they can show you, what they can mean, and how you can use them. So for now, all you need to do is practice spotting major highs and major lows, and I'll see you in the next video.